Folks, welcome to Best Stock Charts for the coming week. This is Bob Desmond for August the 11th, 2018. Let's get started. Let's go over a rundown of what we're going to be talking about first. First off is going to be the musings. What am I thinking about that is driving my analysis of the markets right now? We have landmines all over the world. I'm talking geopolitical events, yet all we are concerned about here in the United States is Dancing with the Stars, hashtag me too, and we have some serious problems. I will be talking about them at the very beginning of this week's commentary. The next topic will be our positions that we took off the table last week. We had a couple of profitable trades. We had one trade that we lost a bit of money in, no big deal. The gains far outpaced the loss, so it was net a good week. Then we're going to go over the stocks that we are looking, or ETFs that we're looking to put on for the new trading week. Now, tomorrow, if you're not a member, join up for the 14-day free trial offer. You don't need to join the gold. You don't need to join the silver. You can get the week ahead commentary, which is our weekend analysis at $24.95 bronze level. Plus, you get access to the forum. That has now been changed. Now let's do the math here. 24.95 divided by, let's say on average, let's round it down. Keep it very conservative. So that's $6.23 per week. Folks, you're paying, let's just say $2.30 per day at 5 times a week for Starbucks. That's $11.50. I think I'm a greater value. Let's get to what we are looking to talk about this week. What am I thinking about? What's driving my concerns with regard to this market besides the technicals of the market, which are beginning to deteriorate? Let's talk about the Shanghai Composite Index. I've gone over this chart many times in the past, and I keep this black overlay here, and that is the S&P 500. And I always like to point out that, by and large, the Shanghai Composite and the S&P 500 trade historically in tandem. Rarely do they not. That all ended here, where we had a double bottom setup in March, then April on the S&P 500, and then a rally to challenge the all-time highs, whereas the Shanghai Composite has since rolled over and broken down into a bear market. Why is that? What's going on? It's the trade wars. Now, what has China done to retaliate? They've devalued the yuan. They've put some tariffs on some U.S.-made goods. But let's be honest here. We look like a third world country with the stuff they're putting tariffs on. For the most part, you have third world countries which export their natural resources. What are they putting tariffs on? Soybeans, other agricultural products. I mean, take a look at the DBA, the Invesco DB Agriculture Fund, just destroyed. Now, is it any wonder that at the time where the DBA, we were long back here, at the time where the DBA was beginning to break out, the tariffs began to kick in. We were hit by the Chinese, and here we are today. Let's go back to, this is May, and here was May, and here's where everything fell apart. So what are the Chinese doing in retaliation for the tariffs by the U.S. government? Well, since there's not much they can apply tariffs to because they don't import much from us, and to be honest, you can't buy into this jargon that the left wants to put out there that they weren't doing anything to us before. Why are we applying tariffs to them? That's BS. Our allies and our enemies have had tariffs on the United States for decades. We just haven't fought back. Now we are. That doesn't mean that we will be spared the fallout from the Chinese retaliation. The fact that the trade wars are driving up the U.S. dollar, let's go to it. You may think that it's great. Wow, the U.S. dollar is driving higher. It's doing outstanding. No way. Remember that the majority of earnings of the S&P 500 are realized overseas. Now, if the U.S. dollar is rallying and you have the euro, the Chinese yuan, the Japanese yen, all in a decline, that makes U.S. exported goods more expensive. And there you have a stealth tariff. So last week, the US dollar ripped higher out of a multi-week base. In all probability, we're coming up here to 97.62, and this rally will not be met with open arms by the S&P 500 community. Why do you think that while, let's bring up a chart of the S&P 500, here you have it, all-time high back in January, we fell shy of it last week. So here's a chart of the large caps. Now let's take a look at the small caps, the Russell 2000. Here was the January peak. We have blown right through that resistance level. So what the charts are telling you, folks, is that the S&P 500 is not being spared the damage that's being done by the trade wars. It's just being postponed a bit. You're not seeing the market decline. However, the S&P 500 is now stalling out. Let's take a look at the Dow Jones Industrial Average. And members, we're going to talk a lot more about this tomorrow on the week ahead commentary. Here's the Dow Jones, nowhere near the January highs. So you have the Dow 30 stocks lagging the S&P. You have the S&P 500 lagging the IWM, the Russell 2000 small caps. So I think a picture here is being drawn of how we are, in fact, being damaged. It's forward-looking. The damage will be seen in the GDP reports for next quarter. Remember, we just had a 4.1% blowout for last quarter. However, the driver of that growth number was the fact that you had companies make purchases in advance of tariffs being imposed. In essence, we pulled growth forward. So these are the musings that go through my mind. You can imagine what a joy I am to live with and how much my wife loves me over the dinner table. So let's take a look at a couple of articles that are out there that should make people concerned. We had the PPI number that was released on Thursday, Producer Price Index. That came in less than expected. But then you fast forward to Friday, and we had the CPI number that was released, and the CPI number just ripped through the ceiling. The run rate on year-over-year core inflation on the CPI was 2.9%. Now, I heard a conversation the other day about how somebody was making about 2.9% on their money market. Wow, how they're doing great. And I said, you know, we just had inflation numbers come in at 2.9%. You're earning 2.9%. You're paying taxes on your income. Therefore, you're losing money by keeping it in the bank. How is that a sound investment strategy? I digress. So core inflation rising. Then you take a look here in the first 9 months of the year, and what they're considering is an October through June beginning of the year. The debt that we had to pay out in addition to the prior year was $40 billion. Now the government is expected in the year 2018 to fork out $500 billion of our wealth. Now, it's not that we're going to the Treasury and we're going to count out $500 billion. No, they're going to print it. They are going to issue more debt to pay the interest. Now, if this sounds like a Ponzi scheme to you, you're absolutely right. It's a Ponzi scheme. But what's the outcome going to be, folks? Here's another headline for you. On the Fed, Trump channels Tricky Dick. In essence, what this is referring to, I'll make a long story short. President Nixon appointed Chair Burns to the Federal Reserve, and for all intents and purposes, here it is. You see to it, no recession. That is what we should expect President Trump to do to Jay Powell. Because to fix this, we need continued GDP growth. One-off quarters of 4.1%, 4.2% aren't going to do it. So in short, folks, while the markets are holding up, we have problems on the horizons. Many of them geopolitical. You have the Turkish lira and the Russian ruble, which are tanking. And you may be saying, you know, really, who cares? They're really third world economies. Well, who has counterparty risk to those countries in the West? There's a lot of it. Let's go to last week's trades. AWX, this was a speculative trade that we put on. We put it on here as we dropped down below 3. This is one I spoke about several weeks ago that we expected. It was the week of the 27th. I expected it to sell off. I wanted to short the shares. I couldn't get the borrow. Believe me, I tried. I couldn't get the borrow. And sure enough, the shares fell apart. So I waited until volume dropped off to the downside. I had expected another rally because people just can't let this go. It's called revenge trade. If they stopped out or they didn't make enough on this rally higher, they're going to try their best to either A, get back to even and obsess on this trade. So I expected a counter trend move versus the sell-off here, and it came after earnings, and the shares spiked higher. We sold half of our position shortly after the open, and I sent out an alert to members saying, listen, we're out half the position. I'm going to, for the remainder of the position, we're up about 100%. We're going to use a 20% trailing stop loss order, and that'll take us out of the rest of the position because I have no idea how much higher this thing can go. There's only 2 million shares outstanding, so for all I know, it could shoot another $10 higher in the day. I don't want to sell out now if I don't have to. However, I want to protect my downside risk. 20% stop loss order, and we were lifted twice. We made 2 new intraday highs on the day, and we were ultimately stopped out. And we made a good piece of coin here on AWX. If it comes back down to us, we see a nice setup in the future, sure, I'll look to trade it again. But I don't expect it on Monday, Tuesday of next week. The next position that we took off the table, and I'm looking to put this one back on, is Cal-Maine Foods. We've traded this one many times. We bought it back here. We enjoyed the breakout. We sold on Friday as we began to see the markets weaken up and Cal-Maine Foods weakened up as well, but it bounced back by the end of the day. If I was still long over the weekend, I would be happy about it. If you're still long, I wouldn't be concerned. I think it closed very well. It's a bit extended here. We're trading up and into the 3 standard deviation Bollinger Band. I'd like to get a pullback and then buy back in on that pullback. So Cal-Maine Foods, a really good week last week. Now, the position that we took a small loss on was DIG. And I was concerned about oil pulling back. And I'm not ready yet to go buying DIG yet again. However, well, before I go into my however, when I want to get back involved, let's talk about why we stopped out. Our line in the sand was $42 per share. Were we to appear poised to close down below $42 per share, we were out. First out, best out. Live to play another day because you had both lines on Stokes down below the 50 level. And that means that you're losing momentum. And the probability of a continuation pullback was pretty good. And even though we had a bullish key reversal on Friday, that doesn't mean it can't be undercut on Monday. Volume was below average. It was okay in terms of volume on Friday, but you had a big down volume bar where we stopped out. So I'm a bit cautious here on DIG. Now, when you're talking about energy, you want to take a look at oil. We'll come back to DIG. We'll talk about resistance levels. Now, oil on Friday, it managed to recapture the 50-day moving average. However, I mean, really lackluster. This is the USO. Volume was light. We have Stokes losing momentum. I'm not loving this sector right now. That could change by this time next week. Back to DIG. So for me to own DIG, I need to see oil in rally mode because the two trade in tandem. So what I'd be looking for is a consolidation within this trading range. I am not convinced that we still can't pull back further on DIG and retest the support level. So we'll watch DIG. We may be long of it by this time next week for all I know. I like this sector, but right now it's consolidating. It's a watch. All right, let's talk about gold. Now, gold has been ruthlessly decimated because of the rallying US dollar. And I will bring you back to my musings. US government to fork out $500 billion to service its debt in 2018. No bueno. The other article, you see it to no recession. That was Nixon to Fed Chair Burns back in 1970. But you could bet that President Trump, especially in front of the midterm elections, will be sending a message to Jay Powell, and he's already been jawboning the dollar down. He is not he's a real estate guy. He doesn't like rising interest rates. He knows how it ends up in recession. The only people who don't seem to get it are the Federal Reserve, because they always go too far with raising rates. So back to the dollar. If the president begins to jawbone the dollar lower because he knows that it's going to hurt overseas earnings of the S&P 500, therefore the 401k plans of the U.S. voter, and I'm purposely using voter because unlike in 1970 where you had very few citizens invested in the stock market, that's completely different now with the 401k plans and IRAs. Now, gold last week smashed through reasonably strong support. Next stop, 114.02. This is the GLD. And we tapped it, came very close to tapping it last week. At some point in time, you're going to see a defense put up of gold and a huge counter-trend rally. No doubt volume is dropping off here to the downside. You have a rounding top below the 20 level on a weekly chart of the GLD. When you get that, it means it's a ruthless sell-off. It's very, very weak. There are no buyers out there. There is a buyer's strike of gold. However, you're going to reach that price level where there is value. And when the market sniffs out value, you see a ruthless counter-trend rally. And that's what I'm predicting for gold in the next couple of weeks. Now, when you take a look at the U.S. dollar, the dollar closed out on Friday above the third standard deviation Bollinger Band, which in short, folks, it's not supposed to be. Now, short term, can it continue this trajectory? Sure. But we do, on a weekly basis, have resistance above. Members, we're going to talk about that and our strategy for the coming week with regard to the U.S. dollar tomorrow on the week ahead commentary. And our strategy for building on our... I'm not buying gold right now. I am buying the gold mining names. Let's take a quick look at the GDX. And in black line chart, you have the GDX. And in gold, of course, you have gold. And I just like to throw them up here to show the correlation of the two. And they're pretty fairly correlated. Sometimes they do not trade in correlation like you had back here. You had the miners rally in July where you saw gold continue to sell off, but they resumed their correlation. It's only a matter of time. Now, the GDX, you're seeing Stokes begin to hook back up. And I think that as early as mid to late next week, we're going to get a rally on the gold mining names and gold. And if you're wondering, you know, you're building a position, what is your game plan? The game plan is long term. I am not looking to put on a trade for a quick swing trade. I am building a core position, and I will not get aggressive with the purchase of that position until, of course, my weekly charts and my monthly charts, more importantly, begin to show a trend reversal in the opposite direction. So gold, GDX on our radar screen. Best Buy. I spoke about Best Buy several times in the past. It did break out last week on a weekly chart. I like the setup here, daily chart. I'm going to start picking it up here. I'm getting along in the tooth with my commentary. We saw a bit of stalling on Thursday and Friday. And what I mean by stalling on Thursday, because I know you're saying, Jesus, what are you looking at here? The shares, yes, did gap up, but you saw sellers move in, taking it off the highs of the day. You saw the same on Friday, so that's a bit of stalling. We may get a pullback and a filling of this gap here. That's fine. I think net, the chart of Best Buy is still looking good, assuming that this market doesn't roll over, and then everything's going to suffer. So all things being equal, the markets hold up. I think Best Buy will continue to do quite well as we begin to break out of this fairly nice consolidation range here. All right, so I gave you my musings about my concerns about the market, about interest rates, about the deficit, about the trade wars, their lingering effect on the U.S. economy, whereas the Chinese are seeing a immediate impact. So what are we looking at here? We're looking at the SPXS. We're looking for a possible short of the S&P 500. Now, we've been consolidating these past few weeks, and you may be saying, really biased to the downside. That's fair enough, and I'll buy into that. But it really all began here, where we formed the Doji Star formation, rallied, failed to break out, pulled back, more Doji Star action, bottoming tails here. The prior week, a bearish key reversal, but no new weekly low. Last week, a reversal bar. We put it in a new weekly low, but we didn't close there. So you're beginning to see a setup here for a potential rally. What does that mean? It means that you're going to see the S&P 500 quite possibly pull back. Now, when you take a look at the price action on the SPXS, where it's been putting in lower lows and lower highs, the RSI has been holding very steady. And in fact, it is beginning to hook up. And it's no surprise we closed up last week. We have a possible double bottom setup on our stochastics. Members, we're going to talk more deeply about putting on a position, when, what must happen, what's our strategy for doing so. We're not going to do so lightly tomorrow on the week ahead commentary. The semiconductor sector, not looking good. This is the SOXS. It puts you short of the semis. We bottomed out on the SOXS. And you'd be thinking, without looking at the chart of the semiconductor holders or the SOXS, given the rally in the NASDAQ, I would bet, without the benefit of looking at a chart, that the semis must be at all-time highs. They're not. They peaked out back here in early June, and they have been stalling. We rallied, we pulled back. We're looking like we're putting in a higher low now. We had a bullish key reversal last week on the SOXS. This is an investment vehicle, an ETF that puts you short of the semiconductor sector. You have Stokes putting in higher lows. You have RSI putting in higher lows and higher highs ever since back here. So this has been going on for a while. This is a bullish divergence, not to be ignored. Volume last week, outstanding. Members, more to come tomorrow on the week ahead commentary. Starbucks. Why do I have a chart of Starbucks up? It's because you're paying more for Starbucks than you are for investing in your strategy for the next trading week. So please sign up for the 14-day free trial offer. Honestly, I didn't plan on doing this plug. It's shameless. I'll admit it. I just happen to have this chart up here, and I figured, what the heck? I referenced it earlier. It would be a good tie-in. So hope you appreciated that humor. But still, sign up for the 14-day free trial offer. Click that bar above. It should be appearing for you on YouTube. All right, continuing on with our bit of end of commentary humor, let's segue into our last chart.
Steve Madden. Steve. You remember those ads? Those giant-headed girls with the bug eyes wearing those big clunky shoes?
My friend from school, Steve Madden.
Friend from school, Steve Madden. Steve Madden was the name in women's shoes at the moment, and all of Wall Street was begging to take his company public.
Go ahead, what is it?
Except guess who grew up with him?
Women's shoes. Women's shoes.
My very own vice president,
Women's shoes.
Diamond Donnie Azoff.
Steve Madden. Steve.
All right, so I had spoken about Steve Madden quite a bit in the past. We were waiting for a breakout. We got the breakout. We got the retest of support. We bought the shares. We booked profits on the 9th. Why? It's because we began to sell off the highs of the day. The market began to weaken up. First out, best out. I still like Steve Madden's shoes. We have a breakout in RSI. Well, I should say I like the chart of Steve Madden's shoes. That didn't come out right. So I still like the chart. Again, all things being equal, meaning the markets hold up, then Steve Madden should outperform the market. But if the markets roll over, we'll be looking to the short side. Members, we'll be talking more about our strategy tomorrow on the weekend commentary, tomorrow being Sunday. For those of you who are not members, please sign up for the 14-day free trial offer. Cancel at any time, no obligation. If you're not ready yet, that's cool. Follow me on whatever social media platform you are watching me on. Leave a comment. Even if you don't agree with me, that's fine. I love a good challenge as long as it's professional. And above all, everybody have a healthy weekend and a profitable trading week next week. Be well.